And it is my pleasure to turn the program over to the chair of our Government Affairs Committee, Marty Malone.
Thank you, Kelly. Good morning, everyone.
Morning, Marty.
And thank you for joining us in the next event in the Government It's Your Business Speaker Series for 2021. As Kelly said, I'm Marty Malone with P. Joseph Lehman Consulting Engineers, chair of the Government Chamber's Government Affairs Committee. And we're pleased to partner today with First National Bank to offer this economic outlook for 2021 for the nation, as well as for the business community in the Bedford County region. We have a panel today of business leaders to speak to their specific industries coming up in a little bit. But first, we'll begin with an overview of the state of the economy. It's my pleasure to introduce Mike Mashonsky, Assistant Vice President of Commercial Banking with First National Bank, for our sponsor remarks and to introduce our featured speaker today. Mike?
Thanks, Marty. Good afternoon, everybody. Like Marty said, my name is Mike Mashonsky. I'm a commercial banker at First National Bank and cover Bedford County as well as the surrounding areas. I just want to take this time to say that we appreciate the opportunity to sponsor the State of the Economy event. Thank you, Kelly and Chamber staff, for not only organizing this event, but for all you do for our community. It is my pleasure today to introduce our speaker. Shane Crawford is a vice president and senior portfolio advisor for FNB Wealth Management's Investment Advisory Group, a registered investment advisor. In this position, he is responsible for evaluating, constructing, and managing investment portfolios for individuals and institutions based in State College and the surrounding areas. Prior to joining FNB Wealth Management in 2012, Shane was a portfolio manager for M&T Bank Corporation. He graduated from Penn State University with a Bachelor of Science degree in finance. Shane has over 20 years of investment experience. He is a certified investment management analyst professional and is a certified financial planner certificate. Please welcome Shane Crawford.
Well, thank you very much, Mike. I appreciate the opportunity to speak with everyone today to provide you with our outlook and some comments on the economy and financial markets. First get started here today, I just have to put the disclosure page up for everyone to look through. And again, just thought I would mention again, my wife and I we actually live in Blair County, but enjoy going to Bedford quite a bit for either shopping or going out to dinner. It's one of our favorite places to go. So again, appreciate the opportunity to speak with everyone today. And get started here just to give you some talking points about the U.S. economy. And again, we'll pull up the chart here for economic growth since 1947, just to put into context what we endured in 2020. And again, coming off of one of the sharpest recessions we've ever seen, in the post-World War II era, the U.S. economy really endured four major events in 2020. Of course, the pandemic, a recession, mass protest, and a presidential election. So, it's very rare that the economy would face four major events in 1 year of that magnitude, but we did last year. And overall, the U.S. GDP contracted by about 3.5% last year. But we do expect the economy to grow in 2021. We expect a nice pickup, especially in the second half of the year as vaccine rollouts occur. And that will should definitely increase the consumer spending, travel, and in general just pent up demand for people to get out and enjoy things and get back to a more normal way of life. Just to give you a sense of what may be expected for the coming year. One of our research partners, Cornerstone Macro, now forecasts economic growth close to 9%. For 2021, and if that's the case, it would be the highest level that we've seen since 1959. Mostly going to be driven by fiscal stimulus, accelerated vaccine rollouts, and states reopening here. And even if we don't achieve 9% economic growth, even if it's 6% economic growth, that would still be the highest that we've seen since 1984. So again, with everything going on, expectations are for the economy to grow pretty nicely in 2021.
Hey, Shane, may
Yes.
I interrupt for just 1 second? What we're seeing on the screen, your main slide that you're speaking to is kind of small. I wonder if it's possible to put it on presentation mode so that's bigger.
Sure.
We're seeing your next slide too, and I think it's making the graphic on the main slide a little smaller and kind of hard for people to see, if possible.
Okay.
Thank you. If not, it's okay. We can watch it on the recording and blow it up, but if it's possible. Thank you.
Let's see here. I'm not seeing the presentation mode.
I thought I saw it when you maybe hit those three little buttons at the bottom.
Okay.
Something like hide next slide or something like that. Maybe hide presenter view. There you go.
Okay, great. All right, so here's a chart of where we're at currently with economic growth and what makes up economic growth in the United States. We're still below pre-pandemic levels at this point. We do expect to exceed those levels at some point this year. Again, the U.S. consumer makes up about 67% of GDP. And with the lofty expectations for economic growth this year, especially related to the fiscal stimulus packages that have been passed. And in fact, over the weekend and just yesterday, Congress has passed President Biden's American Rescue Plan, a $1.9 trillion spending package. And according to Strategas Research, another one of our research partners, they estimate that about $1.2 trillion will be distributed to the economy in the next 5 months. And most of that money is going to end up in consumers' pockets. About $700 billion will be going to consumers over the next few months, and about $350 billion to state and local government. So, one of the things we like to point out here is sort of the context. In terms of the timing of the stimulus plan. This comes at a time when things are definitely improving for a lot of businesses. And back when the pandemic was at its height, they passed the CARES Act, which was about a $2 trillion spending package. And at that time, unemployment had peaked in the upper 14% range. The economy was on the verge of shutdown. So much different set of circumstances that we're in this year. And that comes on top of another $900 billion package that was passed in December. And most of those funds will be distributed in 2021. So combined, what we expect this year, is about $3 trillion in fiscal stimulus versus about $2 trillion that was put out to the economy in 2020. So there'll be an additional $1 trillion of stimulus this year in the context of much lower unemployment, and the economy is on its way to reopening. See, consumer finances here again. As of last weekend, I think when we look at the U.S. consumer here, and what's likely to happen. Again, as of last weekend, more Americans now have the full 2-shot vaccine than confirmed COVID cases in the U.S. since the pandemic began. And I, came across that just in a recent reading and thought it was worth sharing with the group right now. And overall, the U.S. consumer's in pretty good shape. U.S. consumer net worth is at all-time highs, about $128 trillion as of year end. And that's really been helped quite a bit by the stock market, as well as the housing market have boosted consumers' balance sheets. Overall, household debt service ratio remains pretty low right now, lower compared to where it was in the early 80s and even before the financial crisis. So the consumer really has the ability to spend right now. Consumer's not too over levered compared to other points in history, and that may come under pressure a little bit if interest rates go up. But overall, consumers are in pretty good shape. And with the additional stimulus coming here, consumers are going to have an extra $1 trillion in ability to spend. So pretty good shape there. Let's take a look at manufacturing here. The manufacturing index, again, manufacturing doesn't make up as big of a component of our economy as it did years ago, but it's still very meaningful to take a look at because it is sensitive to the business cycle. And what we see here is any levels above 50 on this chart, the baseline, indicate expansion in manufacturing. The February readings were up nicely, right up to 60.8%. And that matches the highest level that we've seen since 2004. And that would correspond typically with an economy that's growing in the 4 to 5% range. So, manufacturing's been on a pretty good run. Let's take a look at the service economy too. So non-manufacturing, again, that's also above 50, which indicates expansion. And we did see a little bit of a drop in the index in February, but that's most likely weather related due to some severe winter weather. So it's not giving us a cause for concern right now. As I mentioned, the low interest rate environment has definitely been good for the housing market. And of course, last year, existing home sales were down significantly between January and May, but then, we're up substantially between that point in time and the end of the year. We see on here building permits, leading indicator for the housing industry, peaked in January of 2020 at 1.55 million units. And now we're well above that peak at 1.9 million units in January of 2021. So again, housing markets has been very strong. Case-Shiller home price index, that's not on here, but just thought I'd mention that that as of year end, that's showing home prices up on a national level about 10.4% year over year. And inventory is pretty tight as well. We see inventory right now is around 4 months supply, and typically on average that's at least 4.5 to 7.5 months on average. So again, inventory is tight, and we did see an uptick in mortgage defaults in 2020. So on the negative side, there was about 3.6 million mortgage defaults, the highest level we've seen since 2009. One of the things that's been used by a lot of economists here during the pandemic is high frequency economic data, just to try to get a sense of what direction the economy is taking here more in real time, as this pandemic goes along here. And some of these figures here were put out by JP Morgan, showing that at the top of the list there are mortgage purchase applications up 16%. That's where we've seen growth, and consumer credit and debit transactions are pretty flat, down about 3%. Essentially, consumers have sort of moved their buying from more towards online goods, but overall kept transactions up. But where we see some weakness still here is in the service side of things, hotel occupancy, travel, seated dinners, TSA travel statistics. Again, that's where there's been a contraction as those industries have struggled substantially in this distancing environment that we've been in for a while now. Goldman Sachs, another firm, puts this on a scale, and they look at a lot of these different economic indicators, whether that's the utilization of video conferencing apps, streaming apps, home fitness apps, and online purchases, as well as what's happening with people looking to search for domestic airline flights and going to the gym, and they scale this out on a level of 1 to 10, and for quite a few months they've been at a level 4, and just recently they moved that up to a level 5. So we still have quite a ways to go in terms of reopening, but they have indicated that consumers are beginning to venture out, go out to dinner, and do some in-person shopping as well. So that is improving. The unemployment rate again, as I mentioned, the peak occurred back in April at 14.7%. Coming off of a 50-year low that was achieved back in February of 2020, it was all the way down to 3.5%. So today we're back to around 6.2%. And the job gains have been a little bit slower here as of late. Also noting that the long-term unemployed, so those people unemployed more than 27 weeks, has risen to 4 million during January, and that's up from only about 1.2 million a year ago. So pretty big increase there in the long-term unemployed. And again, the Fed's target is really for unemployment to be back to that neighborhood of maybe 3.5% to 4%, which is likely going to take several more years for that to be achieved. Labor force participation rate, again, that measures the activity in the workforce, the active workforce, and basically that has been down to the level of around 61.5. So people have stopped looking for work. This would indicate to certain economists, they say there's slack in the labor force. Essentially, that means there's resources out there that aren't being used today. That very well could help keep wage inflation under control, which is a main component to headline inflation, and something we keep a close eye on. But again, there's still quite a few resources out there that aren't being used right now in the labor force. And when we look at the overall job market and jobs out there, January was a disappointing month for payroll gains, but February showed a pretty significant improvement overall, where payrolls rose at around 379,000 versus the expectation was that we'd gain about 200,000 jobs. And they also revised up some of the figures from January as well. So we're still about 10 million jobs below where we were in February of 2020. So still quite a ways to go there, but heading in a better direction. Let's turn now and just talk a little bit about interest rates. Again, this is the chart I know we've probably shared before with the group here, but just shows the significant bull market run in bonds. Significant decline in rates and a rise in prices. With bonds peaking back in the early 80s at 15.84%. In August of 2020, the 10-year Treasury went all the way down to 1/2 of 1%, a historic low. So the path has been generally lower for longer here. And at current levels, if you take away inflation, rates on government bonds are negative when you consider inflation right now. So this long-term bull run in bonds, may very well have reached its peak at this point in time. We'll have to wait and see. But just taking a look here now at what's happened this year with these 10-year Treasury rates, we've seen an uptick in interest rates this year. Again, as there's been a significant increase in economic activity, consumer spending is improving. In January, we saw retail sales up pretty nice levels. Unprecedented fiscal stimulus. So the bond market is moving up as an indication that the economy is getting on more stable footing now. And we're starting to see even some bottlenecks in supply chains. I know just talking to some folks that needed to replace appliances, if you're lucky enough to be able to get them, you may have to wait. So there's definitely some things out there that could lead to some inflation coming down the road. Just thought I'd show you the context of where rates have been. And when we look at the green line here on the yield curve, so on the left-hand side, you have your short-term bond rates, and on the right-hand side, you have longer-term bond rates going out 10, 20, and 30 years. So the green line on here is back at the beginning of 2020, and things were pretty flat. There wasn't much difference between the short-term rates and the long-term rates then. And when the pandemic hit, we had the Fed come in and they lowered short-term rates to all-time lows. So we ended up, in March of 2020, down here at the red line, and rates across the board came down when that happened, as a lot of money flowed into U.S. government bonds due to the uncertainty. And then since then, the blue line on here shows where we are here as of early March. And we've seen that short-term rates have stayed low, but the longer-term bond rates have moved up closer to sort of those pre-pandemic levels. Switch gears here and talk a little bit about what's going on with the Fed. Fed's currently buying about $120 billion of assets each month, about $80 billion in treasuries and $40 billion in mortgage-backed securities, with the goal of trying to get back to that maximum unemployment rate and or the maximum employment rate and about 2% target for inflation. So as the Fed buys bonds in the market, that's keeping interest rates low. And Ed Yardeni at Yardeni Research had put out there that as of January, on a year-over-year basis, the Treasury has issued about $1.6 trillion in notes and bonds. And over that same time period, the Fed has come in and they've actually purchased about 1.8 trillion. So the Fed's purchased everything the Treasury has issued and then a little bit more on top of that. So, with the Fed expanding their balance sheet, stands within reason, we could see the Fed balance sheet up close to $8 to $10 trillion at some point here in the near future. So when we look at the amount of money out there, money supply here, so this kind of encompasses the amount that's out there in cash, checking deposits, money market funds, and CDs. The U.S. money supply has grown over 23%. From being at around 15.3 trillion at the end of 2019 to close to $20 trillion today. So the question becomes, when's inflation coming? Will this cause inflation? Well, the answer really depends here on if businesses and consumers turn around and spend the money that they have, which ultimately contributes to GDP and potentially inflation. So, some perspective on this on a year-over-year growth in the money supply has never exceeded 15% until 2020. So right now, I'd say maybe the risk of inflation is as high as it's been in a long time. The next question will be, will the Fed be able to control inflation? They say they will. They say they have tools at their disposal. They can do things to try to keep interest rates and inflation under control. We'll have to see what happens, but basically, when the Fed stops buying, we'll see what happens with the markets at that point in time. Inflation rate, so the core CPI right now is still pretty low, right around 1.3%. Right now, based on headline inflation, they're saying that inflationary pressures remain tame. There are some spots out there where we are seeing prices going up quite a bit. It's probably going to be a few months too until hotels and airlines come around and maybe raise prices. The Fed has said that the changes in inflation will likely be transitory. And we look at year-over-year comparisons, and when we compare where we are this year versus where we were at the bottom in March and April of last year, sure, we're going to see some increases, in the inflation figures on a year-over-year basis. But the Fed's saying that should be relatively short-term in nature at this point. In terms of the bond market, what the bond market expects inflation to be, we take a look at as break-even inflation rate is the sort of the difference between the 10-year nominal Treasury and the TIPS yield, and right now it's right around 2.24%. But when we consider the amount of stimulus that's been put out there, again, as I mentioned, the CARES Act was about $2 trillion. We had $900 billion in December and another $1.9 trillion this March. That's a tremendous amount of stimulus to put into a $20 trillion economy in the period of 12 months. So, with things reopening and these very significant stimulus packages, we're keeping a very close eye on inflation right now. Certainly don't expect 1980s or late 70s inflation, nothing close to that. But those figures for inflation should definitely go higher. And the U.S. dollar here too. U.S. dollars increased since 2011, still remains elevated. We expect that the deficit will definitely increase as a percentage of GDP this year. So with our trade and budget deficits at the highest level we've seen since the U.S. really went off the gold standard, that's likely going to put continued downward pressure on the U.S. dollar, and additional government spending will contribute to that. So again, that has some investment implications as well. So for U.S. investors, investing some into international and maybe emerging markets may have a benefit there from a currency standpoint. Something to consider. And then commodity prices, as I mentioned, there are some spots where prices are increasing. Could very well be just getting started here in commodity price increases, anything from agricultural to oil. Again, as the global economy recovers here, the challenge is going to be that there'll likely be demand, and whether or not that demand will be able to be fulfilled or not, it may lead to higher prices for things like oil and copper and other goods. And just as an example here, looking back just over the last 3 months, we have oil prices here, sort of the blue line on the chart, up just over 40% in 3 months. Corn's up 29%. And of course, lumber is up substantially as well. This is just a 3-month look at lumber, but even if you go back 12 months or so, lumber's, gosh, I think it's almost doubled in that time period. I certainly got sticker shock when I priced out a few building projects around my house a while ago. So I'll switch gears here and talk a little bit about the stock market. And this is a chart that breaks down the S&P 500, sort of by industry. And you'll see on here, this goes back to the beginning of 2020 through January of 2021. And on the left-hand side, you see the areas of the S&P 500 that have done really well. So some of the stay-at-home themes, your online retail, home improvement, groceries, all those things, did pretty well. But on the right-hand side, the industries most impacted by COVID are listed there. And again, there's certainly some challenges for those industries in this distancing environment. We endured an oil price collapse last year that had a negative impact on the energy industry, and of course, with interest rates being very low across the board, that had an impact on the banks as well. And net interest margin compression was definitely a challenge, as well as increasing the provisions for loan losses, given the overall state of the economy that we were in last year too. So again, the things that did well, last year, we'll wait and see, but there could be opportunity in those areas on the right-hand side of the chart that are more cyclical in nature, that depend more on where the business cycle's at. That as the economy reopens and vaccine results would certainly support some of those industries most heavily impacted last year. And I just wanted to mention too, sort of this rotation going on in the stock market right now. And again, during COVID, investors went into the growth stocks like e-commerce, big technology, things levered to the digital economy that could do very well when the economy was poor. And as a result, a lot of these companies gained significant market share. And really everyone got on one side of the boat. But the value companies, such as the financials, energy, materials, and industrial companies are definitely more exposed to the business cycle and didn't perform very well during the pandemic. But as GDP estimates increase, this year, it'll likely potentially accelerate that rotation. And some of the larger growth stocks that are trading at very high valuations may become more vulnerable to higher interest rates. So again, further gains in the stock market at this point are really going to depend on how corporate earnings come in. If earnings surprise on the upside, you could see some additional gains in the stock market. Right now, I'd say the market has priced in a lot of positive things happening for 2021, and at this point, would also need to look out into earnings that would be there in 2022 for some additional gains at this point. So the Fed buying definitely helps. The fiscal stimulus helps. as long as interest rates and inflation stay under control, those are positive things for the stock market. If those 10-year treasuries, maybe get north of 2.5% or so, that could present some near-term headwinds for the stock market. So, that's our current take on things. Basically, maybe don't fight the Fed. At this point in time, the Fed's still an active buyer, and I also have a few things in the slide deck here on state and local economy. And while I'm not certainly any expert on local economies, I did find a few things that were interesting that I thought I'd share with you today. We have on here the population percent change from early 2010 through 2019 from the Census Bureau. Overall, Bedford County has a slight decline in population over that time, but is similar to other neighboring counties such as Blair County and Somerset County. And the unemployment data here by state in Pennsylvania is listed. And again, Bedford's close to the national average right now, similar to the neighboring counties of Blair and Fulton. So those are a couple things that I have on the local economy for you. And with that, I'll conclude the remarks for today.
Thank you very much, Shane. That was a very informative presentation. Does anybody have any questions, any specific questions for Shane before we bring in our panel? Again, if you have any questions, please feel free to put them into the chat. Any specific questions for Shane before we bring in the panel? Shane, one question I had was, I saw your slide on manufacturing. It was at the highest level since 2004. Is this due in part to playing catch up from the pandemic? Is this sustainable? Do we expect it to go back down, or any thoughts on that?
Okay, there was some feedback loop that I was having trouble hearing your question.
I'm sorry, we are getting an echo here. Let's try it again. Is that better?
Yes, perfect. I can hear you now. Yeah.
I was curious, on your slide on manufacturing, the highest since 2004, is this due in part to manufacturing playing catch up from the pandemic? And what are your thoughts on the sustainability of this? Is this just during the catch up? Is it anticipated to go back down?
Yeah, I would say there is a short-term impact here due to playing catch up from the pandemic. I would anticipate that it should stay elevated as the economic growth is likely to be fairly substantial this year, but I don't anticipate it going significantly higher from these levels. These are pretty high levels at this point in time, so I'd expect some leveling off essentially, but don't expect the U.S. economy to go into a double-dip recession or anything like that this year.
Okay, great.
I have one quick question, if that's okay. This is Kelly. I just saw your local numbers about population kind of holding its own, but I was in a meeting yesterday where one of the concerns seems to be that even though our population numbers seem to be fairly steady, the demographics are trending higher, older. So we have more people retiring here or staying here after they retire. And I'm curious what that would mean as far as economic outlook if our workforce is diminishing, because that's something that we hear a lot from our businesses, that they're having trouble finding workers.
Yeah, that's a common theme that we've heard as well from talking to a number of business owners. It is a major challenge for a lot of counties and a lot of employers right now. We think that challenge is real, and that one of the concerns is that we're going to end up people are going to need to be paid more to entice them to come back to work. And again, like I mentioned before, the wage inflation is a major contributor to headline inflation of a metric that we're watching very closely. So to the extent we see, wages move up substantially, that could have an impact, on the economy.
Thank you very much.
Great. If there are no other specific questions for Shane, we'll ask our panelists to turn their microphones and their cameras on. Thank you again, Shane, for that presentation. Today, we're very pleased to have with us on our panel Dave Hartman, Penn State Extension educator, Steve Howsare, Executive Director of Southern Alleghenies Planning and Development Commission, Tom Salmon, owner of the Golden Eagle Inn, and Shane Weyant, CEO and President of Creative Pultrusions. Welcome to the panel. Thank you so much for being here today. Again, for everybody on the call, if you have any questions, please feel free to put them in the chat, and Kelly will bring them to, we'll read those questions for us. First question we have for our panel today, Shane, if we could start with you, Shane Weyant. Your company works around the country and the world. Can you tell us about Creative Pultrusions, your industry, and your outlook for 2021?
Yes, our focus is obviously with composite infrastructure products. We focus also on engineered systems and solutions to the end market. So we're not a commodity-based company. We put that in motion probably 20 years and took a long time to perfect. So with a lot of the acquisitions we've acquired, we've looked for companies in the growth sectors such as the infrastructure area. And in 2020, we experienced a record year, believe it or not, during the COVID times. We saw probably about 8% growth from a record year in 2019. So our focus has been how we go to market with engineered systems and solutions into the infrastructure market.
That's great. Thank you, Shane. Next question we have is for Steve Howsare. Steve, from a regional perspective, how would you define the current economic conditions coming out of COVID-19?
Well, first off, for those that don't know, we cover 6 counties, Cambria, Somerset, Blair, Bedford, Huntington, and Fulton. So that's our region. A lot of similarities there. But initially, everybody was impacted quite a bit. And then, but from industry to industry, depending on whether you made it on the list of essential businesses or not, some were affected more than others, as well as where your supply chain was coming from. Those who were getting things sourced locally or nationally were having a better time than those who were relying on overseas shipments. So some of the things that we're seeing coming out of it, Shane had mentioned the labor participation rate. It's always been low, or at least in recent times, for Southern Alleghenies, and that's one of the things we're hearing as well, with so many people on unemployment. The additional stimulus dollars are a concern in the fact that some people can make more money on unemployment than they were when they were working. So the manufacturers and other businesses are saying that they can't get employees. So it's just made the situation that we've had around here worse in the short term. So hopefully we can rectify that and get things turned around.
Thank you, Steve. Tom Salmon from the Golden Eagle. Tourism was one of the most seriously impacted industries through last year with restrictions and shutdowns. What is your outlook for 2021? I think you're on mute, Tom.
Okay, sorry about that.
That's okay.
Well, we're very optimistic that it's as things reopen, we'll have a much better year this year than we had last year. Our room rentals are starting to pick up for the late spring and early summer. So that does look good. Last year, of course, was a difficult one for the inn. The community has been very supportive of the restaurant. Can you hear me?
Yes.
Okay, sorry. But the community has been very supportive of the restaurant. That's been terrific. We'll be very curious to see when we can go back to having a bar again, have bar seating. We do have 50% capacity on indoor dining, but we anticipate that the inn will pick up well, that people will be traveling. We are seeing reservations through the rest of the year picking up nicely, obviously a lot better than a year ago at this time. And when things were going in the other direction. And we're quite optimistic about that. I think there's going to be a lot of staycationing. We do anticipate kind of a duality as things reopen. There will be those who will embrace it and be social animals and jump right into the fray. And then those who'll be very much more measured. And there are positives to both. I suspect that our outgoing food services, which increased dramatically this year, will continue to be strong through the end of the year. And we'll just try to get back up and running and keep up with everybody who's out there for a good time.
Thank you, Tom. We're looking forward to that. Next question for Dave Hartman, Penn State Extension. Would you speak to the state of agriculture today and the challenges that the industry is facing due to COVID-19 and other economic factors?
Sure. Yeah. Thanks, Marty. I think a lot of the problems we saw in agriculture actually were worse at the beginning of the pandemic. It was I just saw an article here as I was eating some lunch earlier that described it as upheaval. And I think that was a good way to describe things. There was quite a bit of chaos, and supply chain disruptions was one of the terms that we heard quite a bit. So I work on the livestock team, so we're a little bit more in tune with what went on in the livestock and packing industries. So in a lot of this, you probably read about in the popular press, but initially the problems started with large scale packing plants where we have large numbers of people working in close proximity in an environment which is fairly warm and humid. And it wasn't much but a short matter of time until they had large numbers of employees who were getting sick with COVID. And so the plants in many cases were forced to shut down for a period of time to try to get that situation under control. And of course, when they did that, that caused two different problems on each end. On the supply end coming in, it caused problems with the farms that supply hogs and chickens and cattle to those types of slaughter plants, so that it backed up production on the farms. People had to hold livestock and poultry. In some cases, unfortunately, animals had to be euthanized. There was just nowhere to go with them. On the other end, on the shipping out of the plants, it caused disruption as well in grocery stores. I think people found sometimes that there was a short supply of meat products turning up in stores. And so as time went on, they were able to get those situations under control. And I think, as we got into the spring or to the summer rather last year, things came into more of a equilibrium. Interestingly enough, on the smaller scale side of things, anybody that direct sells meat products or does small scale butchering or moderate scale butchering, their phones were just ringing off the hook. Anybody I've talked to in those businesses, we're finding folks calling them looking for product. They either were afraid there wasn't going to be anything, or they weren't so sure about what was going on in the packing plants, and they just wanted to know where the meat was coming from. So anybody that's direct selling found themselves in a situation where they had a lot more market than they had product to suffice, basically. And the small scale butchers It's not unusual to find people that are actually booking a year in advance. So you can imagine what that does if you're trying to plan to have livestock processed, if you've got to be planning a year and a half ahead. So it's caused some interesting situations in that regard in the meat industry. In dairy, one of the problems that they ran into early was the shutdown of schools. And so, if a milk plant is set up to package milk to go into the school environment, and schools shut down, all of a sudden they've got a lot of milk and they don't have the packaging system to be able to change around and be able to ship it to grocery stores, which had empty shelves because kids were home from school, parents bought store or milk at the store, and there was a run on milk. So you can't just change a packing plant or a packaging plant overnight like that. So, but again, there was milk dumped, of course, until they got that situation straightened out. But over time, it came into some equilibrium, and we don't hear as much right now about those kind of problems. I do remember reading about some problems early in the pandemic as well for large scale vegetable production, same sort of thing. Of course, here in Pennsylvania, we were not in the season yet at that point, but in the southern part of the United States, there was places where they had produce ready to be processed, large scale production of onions and other vegetables like that just basically had to be plowed back into the field because the packing plants that process those types of commodities were shut down or weren't able to operate or couldn't ship out, or the stores were closed or whatever, and had problems there as well. So, so things have, I think, come into equilibrium a little bit in terms of those sort of things. Other factors, of course, in Pennsylvania, as you're probably well aware, over in Bedford as well, there was a pretty bad drought in a good part of Pennsylvania last year. So that's had some impact on folks in a lot of counties. There is some federal relief coming to a number of counties in Pennsylvania to help alleviate impact of the drought from last year. So that was a situation that hit a good part of the state. I think Shane mentioned earlier, some of the commodities are up. So corn, soybeans, the major crops there are up pretty good. Hogs are up. And so there's bright spots like that. Couple different things I just wanted to mention too, that were kind of coming to the forefront basically from the early activity or problems that we experienced in the pandemic would be there has been changes made in some of the larger packing plants to try to, to keep people safe. They're working very hard now to try to get all those folks vaccinated and so that they can continue their work. As far as small scale production, there is some talk about changes in some of the regulations to help folks to be able to foster direct marketing of product. There's a lot of interest in that type of thing right now. And so there's some talk about maybe changing some of the meat marketing regulations. That's sort of a stay tuned kind of thing there. I think a lot of the people that have found their phones ringing off the hook, for people looking to buy meat directly, are kind of wondering how much of that business will stay for the long term. Is it just a flash in the pan? Are we going to be able to keep a lot of those customers? Another thing that's happening is there is some interest in trying to foster more development in the small to moderate scale meat packing industry. So it's a problem across the country. Some folks just term it as a capacity issue. Some folks term it more as a employee issue, that we have the packing plants we need, but all the folks in that business will tell you that they have trouble finding good employees that are reliable, or they have trouble finding employees that are coming in with any training, or both. So one of the efforts that's underway in Pennsylvania that's actually being led by Penn State is what they're calling a butcher apprentice school, which just came into operation in January, where folks are going to undergo a 5 or 6 month intensive training process and then an apprenticeship. and then they will be basically certified in that field and be employable. So there's some efforts going on like that in other places in the country as well. So.
Great. Thank you, Dave.
Sure.
Kelly, have we received any other questions from any of our participants?
Yes. Well, how do you see the stimulus money having a local impact?
And that's for any of our participants, any of our panel or speaker, Shane. So the question-
Tom from the Golden Eagle, anything that gets money in people's pockets will help us, I'm sure.
Hey, Tom, I have a question for you, Tom Salmon.
Sure.
So one of the things that we had heard during the pandemic was obviously business travel was shut down, but it seemed like there were folks coming to rural places from cities to maybe get to a more socially distant place. Did you find that happening with your place? And are you still seeing that?
We saw it in the restaurant. We could see a lot of people who were checking the area out, seeing what was available. Did not impact our inn, but we did see people from the DC area, from Pittsburgh, sort of casing the area out. Yeah, I would say there was a lot of that.
And for Shane Weyant, you guys coming off of a record year and obviously expecting good things in this year, what would you say are your biggest challenges that you foresee over the next 12 months?
Well, the past few years, obviously, the workforce has been a big challenge for us. We've been in Bedford County approaching 50 years, and a lot of our employees have been here 40 years plus. So we have the retirement bug hitting us. And recently, we're facing challenges with transportation, finding adequate shipping methods to ship our products. And another issue recently is being a chemical-based company with the issue in Texas. Believe it or not, there's huge shortages occurring for some of the raw material bases.
Thank you. And for Steve Howsare, you guys have obviously that huge initiative with Startup Alleghenies. And, one thing that we have heard in times of economic difficulties, it creates additional opportunities for entrepreneurs. So are you seeing an uptick in entrepreneurism from your dealings with Startup Alleghenies?
Actually, yes, we have. I mean, we had an initial period where everybody had to learn to work with Zoom and remotely, but since then things have really taken off again. I'm glad you brought that up because some of the statistics I wanted to share. We started that in April of 17. We have just shy of 700 entrepreneurs that have registered into the system. And out of those, 500 have had significant engagements with our partners and our coaches. And we're adding about 20 new entrepreneurs to the system every month. So things have really continued building over time. We've slowly been adding more and more tools to the ecosystem. Some of the things that we've done in the last couple years, we started an angel fund, which is the first one in this part of the state. We've raised $1.3 million for that. And we had a meeting last night. We're already talking about looking to start a second fund come the end of the year because we're starting to complete our, the number of deals that we're going to be able to do with the current fund. And then we've partnered pretty closely with our economic development, like BCDA, JARI. JARI started what's called a growth fund about 5 years ago now, and I've chaired that since its inception. They do some in-depth training with business owners. Some of the significance with that, it's a CDFI, which is Community Development Financial Institution. They're able to loan monies in other areas where traditional institutions aren't able to. And the rates are based on your employment. There's a risk factor survey that's taken, but your interest rates based on your risk and your credit scores and those types of things. But they do loans up to $50,000, but then should have intense training for the business owners with all different types of things to help them grow. So that's just one more tool that we've added to help grow entrepreneurism in the 6-county region. And we expect more things continuing.
Thank you. Another question that just came in: has COVID spawned any new local industries that any of you are aware of, or created new business norms affecting the economy that you see sticking around after COVID or not going away? I mean, I can share one example that I just have heard from our board conversations. REI had planned to build a new headquarters, and they sold their whole old headquarters. And before they moved into their new headquarters, they decided to sell it too. So they are keeping their corporate headquarters virtual, like in folks, people working from home. And for their business, that is in line with their wanting to help the environment, keeping people from running their cars back and forth from home to work, and also cutting down on their brick and mortar expenses.
Ellie, we went through the same thing. We were to the point where we were out of office space, bricks and mortar. So COVID kind of taught us the new virtual method, where now we have excess office space. So that's fairly good.
I was going to say the same thing, Kelly, that I'm not sure how much, I don't think it's going to go away completely, but how much of the workforce is going to stay remote once we're up and running. But it just emphasizes the need for broadband even greater than what we already knew it to be before the pandemic. And that's another area that we've been working quite a number of years on. I saw Larry Myers on here earlier. He's one of the board members of our new nonprofit entity, Alleghenies Broadband Inc., that we formed to address broadband in the 6-county region. And we've made some strides there. It seems like Pennsylvania is a lot harder to get things rolling with broadband in other states. There's so many things working against you. One of the things we ran into initially in Somerset County is the incumbents are allowed right of first refusal, and they can slow things down and drag it out. So we just got PUC ruling in the last week saying that our new nonprofit does not have to seek permission or give that right of first refusal to the incumbents now. So that should hopefully help speed up the deployment of broadband in the region.
It seems like that would be a huge opportunity in terms of economic development here in a rural area, where you could sell the lifestyle of a rural area while you work remotely for a company that might be in a larger area, cities, for that kind of thing.
Yeah, there was a article last week I saw that Sean Bardell was talking about that a lot of people are coming into the area looking to get away from the big cities, and that's one of the negatives was the lack of broadband in certain areas. So hopefully that we can make some improvements pretty quickly to help address that issue while there's still a demand for market for housing and people moving in. That's not just in our region, that's in the whole rural part of Pennsylvania. Right. I'm hearing.
But that trend also creates another challenge, which is real estate. I mean, right now, Bedford County real estate is largely going above market value. There is an inventory shortage, I'm hearing from a lot of real estate folks. If we want to keep young people in the area, there's a real lack of that middle real estate market where, young people don't want a fixer upper, and they can't afford the 4,500 square foot homes that are available. And when you're competing against people coming from the cities where they're paying so much more there for their real estate. That's probably going to be something else that we'll be facing as a challenge, not just this year, but for many years.
Great. This next question is for any of our speakers. Please chime in. What impact do you anticipate the Biden administration policies having on your industry?
This is Tom from the Golden Eagle. Tough to say at this point, where they're so focused on the COVID and the COVID response, that I don't know that there is any great plan in the works that would directly impact us pro or con at the moment, other than that seems to be their focus entirely.
I guess from the ag standpoint, it's probably a little bit too early to tell yet too. Most folks you would ask in agriculture would point to environmental issues pretty quickly. The Secretary of Agriculture, Vilsack, was with the Obama administration, so he's a fellow that's coming back again, and seems to be supported pretty largely by the major ag organizations. So they seem to speak favorably when his name was pitched out to the short list. So I'd say it's a wait and see kind of thing at this point.
Whether you agree with it or not, as far as our entities are concerned and our partners, with the monies coming to the state, we were wondering if we were going to see funding cuts when our demand was up and greater probably than ever. And now it looks like they're going to be able to plug a lot of the holes that the state had as far as the state budget goes. So we're hopeful now that we'll at least see level funding, which is reassuring that we can continue to do the work that we're doing in the region.
Great.
I'm hoping he can deliver a infrastructure transportation bill that we haven't seen in years. But if you look at the facts during the Trump years, our business experienced more in 4 years than what we did 8 years under Obama. So I'm a little concerned there, but maybe the transportation side of it, which we haven't had a bill for some time, could be good.
I'm glad you brought that up, Shane. We're the rural planning organization for what's considered the 4 rural counties: Somerset, Bedford, Huntington, and Fulton. And we work with the planners of the 4 counties and PennDOT to schedule road and bridge projects. And we're looking at significant funding shortages and wondering how we're going to maintain what we have, let alone be able to add to. I know Somerset's been pushing for years for 219, and I'm not sure how that's going to happen with the way funding for transportation is currently in the state without some kind of federal government funding bill. So transportation bill, as Shane said.
Good point. Thank you. Next question, and again, any of our speakers, please feel free to chime in. What is your view of the workforce situation?
I suspect for all of us, this is a huge issue. You get key positions filled, and I think most of us probably do well with that, but just fleshing it out, getting able, willing people to work is quite difficult.
I echo Tom's. We see about a 20% success rate of bringing in new employees. I guess I could say they don't build them like they used to.
Yeah, I guess I already made some comments about that in regard to what we're hearing from small scale meat packing, but I hear that a lot in agriculture in general. Unfortunately, people just have trouble finding reliable employees, but in ag, with agriculture involving a small percent of the population, there's not a lot of farm kids out there to choose from, and the ones that are there get grabbed up pretty quick for different things. And to bring people in to agriculture into those types of jobs. Retain them, in ag is a task in and of itself. And so there's definitely challenges for sure.
Definitely, that's everything that we're hearing as well. We do have some things to help. We do retraining for people who've lost their jobs. We look at targeted industries, come to mind, CDL, transportation, nursing, those types, welders, and we help fund people to be retrained in those fields. It has to be a family sustaining wage industry. And then we also do OJT, on job training grants, which have the same kind of criteria. In our region, you have to pay at least 14, I think 37 an hour to qualify, but you can get half the wages reimbursed up to 6 months. That gives people an opportunity to train the people at a lower cost and hopefully benefit both the employer and the employees. So.
Thank you. Next question. What if anything, can we do as a business community to make our region more attractive to new business or workers, including those who may work elsewhere and live here using technology? What can we do to improve that and make it more attractive?
Tom from the Golden Eagle. One thing that has come up in various forms that I've been a part of is a place for kids to go. Seems to keep cropping up. I mean, mid-teens, late teens, some place for them to congregate. Obviously that's difficult in these times, but something to think about down the road, a place that they can go and find some expression.
It's been mentioned earlier, the staycation. I was talking to Somerset commissioners a couple of weeks ago. Their hotel tax revenue has actually stayed about even with prior years, just for the fact that people were coming to the region and using the outdoors. I know it's been a focus of ours over the recent times to build out trail systems and other things like that. A little bit harder with transportation funding, as mentioned, but that's an area I think that's been working out pretty well. And with everything the way it's going right now, I think it's going to just strengthen our region, have more things like that available. So we need to find a way to continue to fund those types of things.
Great. Thank you. Are there any additional success stories that any of you could share with us in your industry from the last year? Any success stories of note that you can share with us?
I have a couple. This is Tom from the Golden Eagle. For one thing, outside seating has been rediscovered, and I don't think that's going away. In our case, people would come straight into our little pub and never even realized that we had outside seating. With the developments of the last year, and frankly, with PLCB allowing us all to expand our outside seating, that's something that I think for which an appetite has been whetted. And I think that's going to continue to be a strength. I would imagine new restaurant openers would look to having some sort of outside capacity for seating. I would imagine that would become a new priority. And in addition to that, our outgoing sales have improved dramatically. And again, that's something I see as something that'll continue to be strong.
Well, Tom, we should mention you guys did such a great job pivoting from the very beginning to expanding your outside seating. And, there was a lot of businesses that just kind of panicked so much at the beginning, and you guys really thought about what you could do to keep going. And you had successfully created such a loyal customer base to begin with that people really wanted to help you succeed. So you had a lot of stuff going for you because of the way you did business for the years leading up to the pandemic. You should be credited for all of that.
Well, that's the town. I mean, a year ago, we got a shutdown notice on the 16th of March, day before one of our biggest days of the year. And instead of losing tremendous volumes of food, Bedford stepped up and they basically ran us out of food on to-go orders on St. Patrick's Day. We're fortunate in this community to have that kind of an approach. You know, we were flabbergasted at how strong that was.
I guess from the agriculture standpoint, one of the success stories would be just how the ag industry basically was able to retool in some cases, to pivot and go in a somewhat different direction or to adapt to the situation. And I think always knowing that people have to have food. So, you know, we might have to package it differently or market it differently, but the market is there because people need to eat. So years ago, I read an article by an ag economist or a couple of ag economists saying that over time, a macro trend in agriculture is that the middle ground is kind of disappearing. So farms are either getting larger and more specialized and relying on economy of scale to be able to capitalize on a very thin margin, or they're becoming small, niche market oriented and that type of thing. And the middle ground is a tough place to be because you're too small to be efficient with your capital, you're too big to be part-time, and you're probably selling into a commodity market that you're not big enough to be efficient with. So I think that's a trend that we continue to see to this day, that the middle ground just kind of gradually disappears. So we see very big farms and a lot of very small niche market oriented farms that sometimes rely on each other in some ways, but all basically have that goal of being able to put food products out there to keep food in front of people and give them the options that they want. So.
I think on our behalf, our workforce really stayed safe. We didn't have many cases. You know, we may have had some contact tracing here and there, but be able to have a record year and be able to pay out record bonuses in the year of COVID, you know, I give that to our team and how our workforce has succeeded over the years here in Bedford County.
Great. Thank you very much. Kelly, do we have any more questions from the audience? We're about out of time.
I don't see any. If I missed any, I'm sorry, but I don't see any more in the chat. Nope.
Okay.
Thank you.
Okay, thank you. Well, once again, we'd like to thank our presenting sponsor for today, First National Bank, for this very valuable program. Shane, thank you for your comments today. And thank you to our panelists for being with us today and sharing their comments. I'd like to thank our Government Affairs Committee for all the work that you've done on this and other programs. And I'd like to thank Kelly for the leadership she provides to us at the committee level. Please watch your chamber correspondence for upcoming speaker series events, which will hopefully soon be in person. Thank you so much for joining us today, and have a great week, everybody. Take care.
Thank you.
Bye-bye.
Thanks, everyone.